Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at Options Play. We had a little technical difficulties getting started here, but we're looking at doing the Greeks. This is my favorite presentation to do, honestly, and I do think that a lot of people get scared away because you say, oh, the Greeks, it's math, it's that. But we're going to break down the math. We're going to make it very simple, very straightforward when it comes to the definition of the Greeks. We'll give you all the scary textbook definitions, but I'm going to explain it in a way that you'll never have to look at the textbook definition again to really understand the Greeks. And I do feel that it's very important for beginning and even more so for advanced option traders to understand the Greeks when you're trading options. You might not think so, but it's not necessarily what the definition is, what the delta is, what the gamma is. It's understanding the whole picture, how they all work together, all these different pricing scenarios that can happen when you're trading options. All right. So before we get too far along, I do have to let you know that anything that we show today or anything that we talk about is not meant to be a recommendation. Past performance is not a guarantee of future results. If you're going to trade options, you do need to review the characteristics and risks of standardized options. You can get that from First Trade if you would like, no problem, or any other exchange that actually trades options that is available to you. And always want to let you know that options do involve risk, and sometimes you may lose your entire investment when trading options. All right, so we have four basic positions. We're going to look at the delta for the call, for the put. We're going to talk about selling option contracts and how that affects delta and how that reacts in your position. We're going to look at selling a call and selling a put, but these are the four basic trades. But bottom line is, if you're trading options and you want to really get a grasp for it, you need to understand the Greeks. You need to understand the pricing before you can really understand option trading. Now, you can go your whole life and never know what the definition of delta is. And if you are a basic covered call writer, for example, which is probably the most popular strategy in option trading, you're going to be okay. You're going to be just fine, right? But if you want to take your game to the next level, well, then we need to understand the Greeks. All right, so without further ado, let's meet the Greeks. If I look at the Black-Scholes pricing model, right? We're going to spend the next hour deriving this. No, we're not. It's just why, right? It's been done. This is a very important model that was developed in 1973, the year the Chicago Board Option Exchange opened up listed option trading, and it helped put a little foundation around the pricing on options. Doesn't even matter what that formula is, even though it is a very straightforward formula. The thing that I brought this up for is just to show you that part of the model, everything that's in this model that gets input to the model has its own Greek. You got the price of the underlying, you have the risk-free interest rate, if there is any dividends that are paid by the stock, you have time to expiration, and you have the rate of return of volatility. Volatility is the big thing that really affects the price of an option contract, independent of everything else, right? So every one of those variables has its own Greek. Now, I'm not going to sit here and read you the definitions of the Greeks, because I just explained that by reading the definitions does nothing for the option trader. If you want to understand it, let's work through some examples and let's make it real. Here's all I'll say about this slide is delta, that's price movement. Gamma, delta is so popular and so important because it's about price that they gave it its own Greek. It's called gamma. Another Greek, theta, that's time decay. Vega, not even a Greek letter. It's actually a constellation up in the sky. But bottom line is Vega starts with the V. So easy to remember, that goes with volatility. Rho, interest rates. This is the only thing I'm going to show you with interest rates. And interest rates do matter, especially with everything that's going on with the Fed nowadays and what just happened in Jackson Hole and everything. Rho only matters if interest rates move. And it in particular matters on option contracts that have very long expirations. Why? Because low interest rates can make money if you hold them for a long time. So Rho doesn't really matter on shorter term option contracts, but it does matter on long-term option contracts. And that's all I'm going to say about Rho. We're going to focus on these three Greeks today, and the relationship between them, delta, gamma, and theta, okay? So let's talk about delta. And at this point, I think I want to step back and say, if you have any questions, you can put them in the Q&A box. The chat box is not available to you, but I will try to address any questions that you may have in that Q&A box. And I have it up on my on my other screen that I keep looking over here at. And if you do want to go right along anytime, just go ahead and throw one in there, and I'll try to address most of them at the end, but I will do some along the way. So here we go. That's delta, the big one. So here's the textbook definition of delta. It's the amount of theoretical options price will change for a corresponding 1 point change in the price of the underlying. So the stock goes up 1, how much does my option move? The stock goes down 1. How much does my option move? That's what delta will try to give you, is a realistic expectation, even though it's in a theoretical world. So we got to take what the market gives us. Delta is derived from the options pricing model. Any pricing model will throw off a delta, if you will. But if you really understand delta and where it comes from, you don't need that model to get a good feel for delta. And here let me explain further. We're going to go through a scenario. Stock is 50, strike is 50. We have a 2-month call option trading at $3. Stock goes from 50 to 51. Our 2-month 50 strike call option was trading for $3. My question to you is, what's it trading for now? And you can put that answer in the Q&A box if you would like. If you just want to put a value in there, feel free. But what's your best guess? I bought an at-the-money option contract, to use, the lingo. Stock was 50, strike was 50. I paid $3 for that option. The stock now moved from 50 to 51. I'm a really good stock picker, obviously. What is my option trading for now? What is it worth? And obviously, delta would help you with this because we just defined what delta is. But what is that worth now? What would be the value of this option contract? And I can't move on until at least somebody answers in the Q&A box. And there's quite a few of you out there. So I'll just take a little drink of my water over here. And I'll wait till we see an answer in the Q&A box. You got to play in my reindeer games if you want to learn about delta. Okay. Kaylin says $5. I want to trade with you, Kaylin. It's a little bit pricey. All right, we'll go with that. Great example. All right. You need to have a realistic expectation. And now here, we'll go back and take this one step further based off of the one answer that we did receive. And thank you for answering. Thank you for playing. Is that, think of what an option is. An option is a derivative. It is derived from the price of something else. Very rarely, if you just think about that concept of what a derivative is, if you go in and if the underlying that it's derived from goes up $1, very rarely are you going to make more than $1 on your option contract, right? So the underlying would make $1. The derivative is going to in more cases than not, make less than $1 and not going to make more than $1 ever. And this is all in theory, everything that goes along with it. There are some other factors in the marketplace, but this is in general the case. The answer is, and Justin got it right, our last answer here inside our reindeer game in the Q&A, it is $3.50. All right. So now it gets interesting. So we're a good stock picker. The stock went from 50 to 51. Our option went from $3 to $3.50. Now let's move the stock again. Let's say we're a great stock picker. And now within a second, we see that our 2-month option contract is now trading on an underlying that is at $52. Ready for it again? So this one I'll make simple for you. Now that the stock has moved from 51 to 52, did our option go up more than 50 cents or less than 50 cents in the next point movement? Right? We already said it can't go up more than 1 because it's a derivative. Did it go up more or less? And you don't necessarily have to answer that because Justin says yeah, less. Justin got the first one right and the second one wrong. All right, Justin. But thank you for that great answer. The answer is more. And this is what we're going to try to figure out. Why is the answer more? Why is it more? Why in the first point movement does this go up 50 cents and the next point movement it goes up 60 cents? And in order to do that, I have to introduce a different definition. And this definition is not a textbook definition. It's not even 100% accurate, but it is accurate enough that it will give us a good feel for what a delta should be. And that definition is that delta is based off of the probability of the option being in the money on expiration. And I'll even add to that. I'll say it's the probability of the option being in the money at least 1 cent at expiration, right? What are the odds of the 50-50 stock, with the stock at 50 and the strike at 50, on our call option at the stock finishing at least $50.01, right? What's the odds of that happening? And that's where delta comes from. As a matter of fact, it's so much so that when I used to work on the Chicago Board Option Exchange, everybody used to talk about delta. Hey, Jim, do you want to go to lunch today? Oh, 10 delta. I don't see it happening. The markets are really rocking and rolling. Afterwards, hey, Jim, do you want to go get a beverage at the Cactus across the street from the Chicago Board Option Exchange? 90 delta. I could really use a beverage after this tough trading day. That's how market makers talk with one another. They always say this is the probability of something happening. And it's all based off of the fact that delta is such a staple in how they are trading their options and how they are managing risk. Well, that's a different topic for a different time. But now let's go back to our example and let's think about why I told you this and why is this important. The stock is 50, strike is 50. What's the odds of it finishing in the money? 50-50. If it goes up, it's in. If it goes down, it's out, right? You're right at the money. At that point in time, the probability of it finishing in the money is about 50-50. So guess what the delta was? Around 50. And I'm pretty sure that Justin probably knew that. Justin knew that that most at the money options have a delta of 50. Most people understand that. And if you've read anything about delta, you get that. But what if it's not at the money? What if the stock is now at 51? Well, what happened to the probability of it finishing at least 1 cent in the money? Well, it just increased, right? It just went up. So guess what? Delta went up with it. So in the first point movement, the delta was 50. In the second point movement, the delta was 60. There was a 60% chance based off of just looking at delta of this option contract at least finishing 1 cent in the money. Now, I want to emphasize that this isn't the probability of making money, right? If it finishes 1 cent in the money, you're still not doing very well, right? Because you paid $3 for it. The break even would be 53 on this call option. So it's just the factor that is used to try to determine how much your option contract will move as the underlying stock moves in and out of the money or even hangs out at the money. All right, so now it's at 52. Guess what? The delta is even higher. And the deeper and deeper we get in the money, delta is slowly going to approach 1 and not go beyond 1. Why? Because it's a derivative. It's derived from the price of the underlying. If I get 1 on that thing that it's derived from, my option contract can't give me more than 1. And what's the lowest it can go to? 0, right? It can't go below 0. It can't get negative. You can't lose negative money on your $3 option contract. You bet $3, you put $3 in on it, $3 is what you can lose. You can't lose $3.50. You can't go below 0, all right? So that's how the delta works. So very straightforward. So this is how delta works relative to an at-the-money option contract, most delta, so what's the moral to the story? Most contracts, if they're at the money, they're going to have a delta that's close to 50. And if they're out of the money, they're going to have if they're out of the money, the delta is going to be lower than 50. And if they're in the money, the delta is going to be higher than 50. Okay. So if you take this definition, and this is all that I'm going to talk about on puts, let's see if we can get this one right. Let's see if we can get this one right. All right. So if the delta on the call for the 50 strike call with the stock at 51 was 0.60 or 60, right? The way it's going to look on an option chain, and most chains, it's going to say 0.60, which would translate to one option represents 100 shares or a delta of 60, all right? Which means that if the stock goes from 51 to 52, that your option contract should go from $3.50 to $4.10, up 60 cents, or for the one option contract, up $60. So that gets a little confusing with delta because you look at the chain and it says 0.60, but then you have people like me saying the delta is 60, right? And the delta is not 60, it's 0.60. But as far as an option is concerned, if you multiply 0.60 times 100, the number of shares the contract represents, the delta represents $60 worth of value, if you think of it that way. All right, so I always want to, because that does get a little bit confusing. Most option chains would show this delta at 0.60, means the stock goes up one, you make 60 cents, which translates to $60. You can replay that as many times as you need if you if that didn't grasp the three different ways that I explained it. Okay. So 51, stock's at 51. Delta on the call is 60. What's the delta on the put? Anybody know? The delta on the call is 60. Means that the put option contract would be out of the money. Strike is 50. You have a 2-month put. What would be the delta? 40. Yeah, Justin's got it. Jeff got it too. Kaylin got it too. Nice. Perfect. You guys are listening out there. I love it. Yeah, it would be, because you know what? It has to add to 100. Either the call's going to be in the money or the put's going to be in the money. And if it's based off of probability, if the call probability of being in the money is 60, the put probability of being in the money is 40. If the call probability of being in the money is 75, i.e. the delta, then the put is going to be 25. Now, on the put side of things, if you look at the chain and you look at the deltas, it's going to be a negative delta, meaning that if the stock goes up 1, your put's going to go down by the amount of delta, in theory, you know. But with that said, they're still going, if you take the absolute value, they're going to add to 1. And that's in theory. It's not always perfect in the real world, but it's usually fairly close. If you have extremely liquid option contracts like in the SPY, the ETF that tracks the S&P 500 index, the deltas are very accurate just because the marketplace is so efficient. Okay? Awesome. I'm so glad everybody got that answer right. All right, so let's dig deeper. So now I'm going to blow your mind. Okay, we got rid of the textbook definition, and I don't care if you ever quote the textbook definition again, but I love the non-textbook definition. The delta is the probability of the option being in the money at expiration. So in this scenario, the stock is 50, the strike is 50. We have 1 day remaining to expiration. 1 day. We went from 60 days to 1 day. All right. The delta was what? 1 day remaining to expiration. From 60 days to, from 60 days with the stock at 50 and the strike at 50, what was the delta on that option contract? From 60 days, we said the delta was 0.50. Now we have 1 day remaining to expiration. What's the delta? I got a little click happy there. What's the delta? Well, I gave it away. The delta's 50. As a matter of fact, you can't get more 50 delta than this moment. The stock is 50, the strike is 50, it's 1 day remaining expiration. If the stock ticks up 1 cent, it's in the money. If it ticks down 1 cent, it's out of the money. You have the most 50-50 situation that you can come up with. So, at that point in time, the delta is going to be 50. But what changes? We already knew the 60-day delta was close to 50. Let's move the stock. Let's make the stock 51. What's the delta now? 1 day remaining to expiration. The stock is 50, the strike is 50. What's the delta now? And Kaylin, I'll try to address. I don't understand how the call delta goes from 10 to 50 in our scenario. Okay. We're going to define that. That's called gamma, Kaylin. Well, Justin had a great answer. More than 60 is the answer, and the answer is yes. It's now 90. Okay. So now this is the concept that this is when I started this event, I said, you won't ever have, well, I'm not going to say you don't ever have to, but you will always now have a feel for delta if you understand the non-textbook definition. And you don't necessarily need to look at a chain to understand how delta is now working for you or working against you. So stock is 50, strike is 50. Stock goes from 50 to 51. To start with, you had a 50 delta. The delta is now 90. Why? With the stock at 51, what's the probability of this 50 strike call option finishing 1 cent in the money? Extremely high. And this is actually from a pricing calculator that I've used before to put these slides together. So these are real numbers in that if the stock goes from 50 to 51, the delta goes from 50 to 90. We know on the 60-day option contract, we just proved that the delta went from 50 to 60. Why? You have 60 days for it to get out of the money. In this instance, based off of this definition, time is not your friend, right? If I'm just thinking about in and out of the money, having 60 days left means that can the stock move more than one on the downside in 60 days? Yes. Can the stock move more than one with 1 day remaining? Probability is pretty low, right? 1 point on a $50 stock is a fairly high percentage overall. Could it do it? Yes. But the probability of it doing it is only 10%. Which is the difference between 90 and 100. Okay? So Kaylin says, so in this example, when we went from 50 to 90, it's because gamma was .40, and that is correct. That is a correct answer. Ding, 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 ding. So let's define it. Well, here, let me show you the table, and then we're going to define gamma. XYZ trading at 103.24. These were real numbers. XYZ used to not be a stock, but now it is, unfortunately. But XYZ at 103.20. So here's the difference between an 8-day option contract and a 42-day option contract. Here we have a strike 100. Everybody agreed that on a call option, that's $3 in the money. So with 8 days remaining, that delta is 76. We're a little bit in the money. We're $3.27 in the money on the 100 strike call. The delta is 76. We go out to the 42 days. We are the same amount in the money, $3.27. But this option contract will trade for more because time is money, but the delta is 64. So in this instance, the probability of this strike with 8 days remaining finishing in the money is higher than the probability of this strike with 42 days remaining. Even though it's more expensive, it doesn't react to price movements as much as the short-term option. 105 strike. Let's flip the script. Now we're a little bit out of the money. Trading for 115, delta's 37. Now time is my friend. I only have 8 days for it to get in the money. Over here, 105, trading for more because time is money, $3.60. Delta's 46. Why? I have 42 days to get there. So I need the time to get in the money that I don't have on this one. And that gets reflected in the option contracts. So the further I go out of the money, I pay a little bit more for it, but I get more delta. So if I'm buying out of the money option contracts, just in general, I like to buy time. I'd like to pay up for this, get a little bit more delta. I can always sell it after 8 days if I want to, but I get delta. I pay a little bit more. I have a little bit risk. I can't buy as many of them as if I buy the 110 strike options. But to go along with this, I also have theta, which we're going to introduce here. So my delta's tiny. On a percentage basis, it's big, but every day that goes away, I also lose time premium because I'm way out of the money, 103 to 110 strike. So I kind of like going a little bit out of the money, going a little bit further out in time if I'm going to buy out of the money options. That's still a very speculative trade overall, but also think about how this happens and how you want to react when the marketplace is moving with you or moving against you and expiration is approaching. Think about the fact that if it gets way out of the money, it's going to take a lot for this option contract to get back to the $4, right? Or even this option contract. If you paid $4 and now it's an out of the money option contract, delta is going to go down, where delta is still solid enough on our May call options. So the moral to the story is, if you're going to be correct, you want high delta. If you know it's going to get in the money, it's very important for it to get in the money, because if it doesn't, delta drops precipitously, and just hanging around and playing the hope game really hurts as far as delta is concerned. Delta is not your friend when you're out of the money as expiration approaches. All right. Any questions? We've been doing a good job. We've had a great discussion in the Q&A box, and I really do like that. Okay. Gamma. So now we got the gamma. So in this instance, we are going to define gamma, but we've already defined it as Kalen inside the, I think if I click answer live, it pops up for everybody. But she already did define it and already figured this out, what gamma is. So in this instance, meet the Greeks, let's define gamma. Gamma is the amount of theoretical options price will change for a corresponding 1 point change in the price of the underlying security. Now here's what's important. That definition, gamma is the derivative of delta. So delta is the derivative of the stock price. Gamma is the derivative of delta, and you can keep going. You can figure out gamma's derivative. You can figure out theta's. You can have 5 or 6, but eventually it just becomes moot, because first of all, it becomes so small and all this, but it's math. You can derive anything from everything almost. All right, so gamma is highest for the near-term at-the-money strike and slopes off towards in and out of the money. And that's what we proved in our scenario. We proved that a 60-day option has a lot less gamma than a 1-day option. And we showed it in the table, we showed it in this. So ideally, we already defined gamma, but we just didn't call it gamma. And so it's always going to be skewed a little bit. Here's one of the things that I failed to mention, and this is because we're in theory. An at-the-money call option and an at-the-money put option, the delta on the at-the-money call, if it's exactly at the money, is going to be a little bit higher than 50, and the put is going to be a little bit lower. And it has to deal with, and I don't want to make things too confusing, but it's based off of the time value of money. It's that simple. It's put call parity, little things like this, synthetic relationships. Bottom line is it's going to be close to 50. Delta on the call side, it will be a little bit higher, and on the put side, it will be a little bit lower in the real world. Okay, but don't let that mess with your mind. Okay, hopefully. Graph of gamma at the money. You got a 15-day 85 strike call. The 15-day gamma has very high gamma, almost 10 cents in this instance on this 85 strike call. On the 45-day, it is less. It is down around 5. And it's skewed a little bit in this direction, and that's exactly because of the things that I talked about, and that's why I talked about them. is in this scenario. And this is the 45 strike. You see that the peak is just not quite as high. And you also see that it drops off precipitously with gamma as expiration or as option contracts get further and further out of the money, the gamma has to get smaller, and further in the money, the gamma has to get smaller. Why? Because it's a derivative delta. Delta is either going to approach 1, and it can't push it beyond 1, or delta is going to approach 0, and it can't push delta beyond 0. So gamma's highest on the at the money, gets smaller as you get to the extremes, either delta getting to 1 or delta getting to 0. In our example, we had an extreme example of an exactly at the money option contract with 1 day remaining to expiration. And all of a sudden it gets in the money. Gamma explodes delta. And this is really a situation with 0 DTE options. If you are trading 0 DTE, which means that it only lives for 1 day, and it's not even a full day, because if you put it on that day, right, you put it on during the trading day, and then you have until the end of the trading day. There's a trade-off, and one of the biggest trade-off is as expiration approaches, every hour that goes by, gamma gets explosive. So if you're selling option contracts and they go against you, they hurt really bad. Just like you think about this, I sell an at-the-money option contract. There's 1 hour remaining in the day. Stocks at 50, strike is 50. You got 1 hour remaining, right? Either delta's going to 1 or delta's going to 0. And it's going to happen like that. So every tick of the stock is going to be a big movement. And talk about gamma. 0 DTE options are all about gamma and trying to manage it. And what's the trade-off with gamma? Well, first of all, if you're going to be correct on your forecast, you want high gamma. If you are going to be correct, if you buy the 50 strike call with 1 day remaining and the market goes up, man, your delta explodes and you get rewarded really quickly. If you're going to be wrong, gamma is a real pain in the butt because it makes it real hard for your call option to get back to the normal valuation. And so if I'm trading options and I think I'm going to be correct on my forecast, I love high gamma. But what's the issue with high gamma? And and actually this is I forgot I put the slide in here, Kalen. But this is exactly, like I said, we defined it, right? Gamma in this situation, when the stock was 50, strike was 50, gamma was 0.40. Stock is 50, strike is 50, 60 days remaining, gamma was 0.10. But here's the trade-off, theta. And this is always the balance that you're trying to understand. What I want high gamma, but if I have high gamma, I'm going to have very high rates of time decay. I'm going to have high theta. But if I'm buying option contracts, I don't want high theta, but I want high gamma. Ugh, which one do I want? And that is always the battle. Gamma versus theta in the Greeks world is the battle that everybody's trying to figure out. So what is theta? It's the amount of theoretical options price will change for a corresponding 1 day change in the days to expiration on your option contract. Bottom line is it's time decay. So if I look at the rate of decay, especially on at-the-money option contracts, which have the highest gamma, right, you're going to have a large rate of decay. So I have a scenario here where the 60 days to expiration, we're at the money in this scenario. We start at a 90-day period, 90 days to expiration, and we have an at-the-money option contract. It's trading for $1.73. 30 days go away. We have a very linear rate of decay to start with, $1.41, almost a 1-to-1 ratio, a little bit more. We go from a 60-day down to a 30-day. Now look at that slope. It's getting a little bit greater, and we lose $1.41. So here we lose 32 cents. Here we lose 41 cents. And then in the last 30 days, it's like, wham, my sled hit the tree, right? We're all the way down to 0 in this instance. And look at that huge rate of time decay. So what option contracts were we looking at? Ginormous theta, ginormous gamma. If I'm going to be correct, I want high gamma, I want low theta. It doesn't happen. All right, so I'm going to blow your mind here. Ready? If you look back at that Black-Scholes slide, you'll see a lot of square root signs in there. And I had to kind of make mine up here, so my slide's a little janky. But with that said, options move at the square root of time. I don't know if that's an exciting concept that you need to go and tell your friends and family about. I can pause here. But if not, it's an important concept. So here's the way it works. And the math actually works really well. This is one thing in the theoretical world that kind of plays out. If you got a 1-month option contract, 30 days is worth $1. You got an at-the-money option contract. You would think, well, gee, logically, if I did a 2-month option contract, that would be worth 1 times 2 or $2, right? Now you have 60 days versus 30 days. Well, that should be worth $2. Then if I do a 3-month option contract, it should be trading for $3. Well, the math actually is, it's 1 times the square root of 2. And 1 times the square root of 3. So this is how I made that graph. If I can jump back up here, you see 171, 141, $1. Go back here, 170. This is how the math works. So in an ideal world, a 360-day year, 30, 60, 90-day option contracts, right, where everything's all controlled, this math works. And this is how your premium would be. If you saw a 1-month option contract trading for $1, you could figure out what a 2-month is without even looking at the quote because of the way time decay works. But the bottom line is gamma versus theta. That is always the value. And as a matter of fact, some option pricing calculators will give you an epsilon or a different Greek where they divide gamma by theta. I'm not going to go to that level. I personally don't use one. And it's mainly because if you understand this concept, it's not that important. Here's where it's important, right? Is if I'm going to trade 0 DTE options, I need to know that if that option contract gets in the money, it's going to hurt. It's going to hurt very bad. So Tony, one of the founders, the chief options strategist, has done a lot of seminars on 0 DTE options. And one of the biggest things we always say is put it on in the morning. Markets open at 9:30 a.m. Eastern time. Put it on sometime before 10 and get out, right? Get out at 1 o'clock, 2 o'clock in the afternoon. Don't ride this, even though that's the highest rate of time decay. Gamma and delta take over. So let's try to find that mix where, the epsilon, the theta versus gamma is okay to get out of the trade. And if a trade works out by 1, 2 o'clock, okay, great. If it doesn't, get out, or else it could really hurt you in the last couple of hours. And you can apply that too. So like longer term option contracts, we look at doing 45-day options inside the options play platform. If you're thinking about the masses, right? A lot of our short call spreads are 45 days out. And it's all because of this relationship between gamma and theta. If you do short call spreads, let's stick with the short call spread side of things. So if we're doing a short call spread and you are wrong, right? Let's say you sell a short spread, and you can sell a short call spread. You could sell a short put spread. Selling a short put spread, I'm bullish. Selling a short call spread, I'm bearish. If I do this and I'm wrong, time value is my friend, right? If I am wrong on my forecast, the time value protects me and allows me to either adjust the position or even close it for less of a loss. If I'm right on the situation, I want time value to go away. I'm doing this for a net credit. I want to be able to buy it back for as little as possible. So a nice little range as far as you could even say gamma versus theta is you sell a 45-day, you get out with 21 days remaining because you're playing that battle. I'm selling the 45 days. If it goes against me, I need some time premium. And as expiration approaches, I get closer and closer. Now gamma can really hurt me because I don't have any time premium to protect me. So if I get down to 21 days and nothing's happened, stock hasn't moved, not really making anything on the trade, I could just get out because I don't want the gamma risk from 21 days on in. Does that make sense? All right, Kaylin. Oh, I love that. That's an emphatic yes inside there. I think this is going to be it. Like I said, now do you need to look at delta? Right? You have a pretty good feel. You can guess. You can say, okay, my option contract is 3 points in the money. We're 60 days out. What should my delta be? You have a fairly decent, you can make an educated guess as to what your delta would be. Now, ideally, you're still going to go in and you're going to look at your option chains. You're going to still look at your deltas, and that's very possible. And I'm not saying that you shouldn't, but you should understand that number better now. And then, Vega is volatility and Rho is interest rates, and they're independent, right? Vega is how much your option will move for 1 point movement in volatility. Very important, but they don't tie into each other like delta, gamma, and theta do. My name is Brian Overby. Follow me on x.com. My handle is @BrianOverby. Check out the Options Play website, which is available. A lot of the tools are available inside the First Trade platform just for being a client. And I have a little book that's called the Options Playbook if you would like to learn more. All right. I don't see any more questions. Kaylin says the book is in the cart. I appreciate that. All right, and so I always like to leave, we're going to leave it right there, and I always like to leave my seminars with a little statement and just a little wish for you that all the options that you buy will finish in the money, and all the ones that you sell will finish out. Thanks for tuning in.